The global economy is bracing for a fresh wave of inflation. An ongoing war in Iran has severely disrupted energy supplies, sending oil prices higher and putting immediate pressure on the cost of goods around the world. The responsibility for managing that pressure falls to the United States Federal Reserve, the institution that effectively controls the throttle for the global economy. But the central bank is operating under intense political heat. The U.S. president is openly demanding that the Fed aggressively cut interest rates to stimulate the economy, broadcasting these directives daily across social media. To execute that mandate, the White House has nominated Kevin Warsh to be the next Fed chair. A former central bank governor and Wall Street veteran, he has openly campaigned for this specific job for nearly a decade. But taking over the central bank right now means walking into an active legal and political war zone. Current Fed Chair Jay Powell is the target of a highly politicized criminal probe, launched by a U.S. attorney closely allied with the president. At the exact same time, the administration has attempted to fire sitting Fed Governor Lisa Cook, a move that has sparked a historic legal standoff that has escalated all the way to the Supreme Court. To survive his tenure, Warsh will have to appease a president demanding cheap money, manage a global economy that punishes cheap money, and somehow defend a central bank whose operational independence is actively under siege. Warsh is entering this chaos with a specific set of operational goals. He has spent the last 15 years arguing that the Federal Reserve communicates too much and intervenes too often. His first target is the dot plot, a chart released 4 times a year that shows exactly where each Fed official expects interest rates to go. Warsh argues these public forecasts trap policymakers into keeping promises that might not make sense if the economy shifts, while causing financial markets to obsess over every tiny update. This animated chart shows his second target, the Fed's $6.7 trillion balance sheet. By buying up massive amounts of government bonds during the 2008 financial crisis and the COVID pandemic, the central bank flooded the economy with cash. Warsh believes the Fed should slowly sell off those assets. By pulling that cash out of the banking system, he argues the Fed would be tightening financial conditions, which would theoretically create the economic headroom to start cutting short-term interest rates. Combined, these ideas represent a rejection of the highly communicative strategy the institution has relied on to soothe financial markets for the last decade and a half. However, there is a disconnect between Warsh's internal roadmap and the current economy. When the Fed shrinks its balance sheet by selling U.S. Treasury bonds, it drains liquidity from banks. When banks have less cash to lend, longer-term borrowing costs, like consumer mortgage rates, naturally go up. Add to that the ongoing conflict in Iran. With oil prices sitting far above their pre-war levels, the baseline rate of inflation is already running uncomfortably hot. Market data reflects this conflict. With oil prices high, futures trading currently shows less than a 50% chance of even a single quarter-point cut for the entire year, making the White House's demand for immediate easing difficult to justify. But right now, Warsh's economic strategy is entirely hypothetical because he cannot legally enter the building to start the job. In the Senate, Republican Thom Tillis is blocking Warsh's confirmation from going to a floor vote. He has stated he will hold up the process until the criminal probe into Jay Powell is dropped. In response, Powell is refusing to vacate his seat until Warsh is officially confirmed, leaving the world's most powerful financial institution frozen in a state of transitional limbo. By launching legal attacks to exert control over the central bank, the administration has created a political traffic jam that is currently keeping their own hand-picked reformer out of power. Paradoxically, this delay might offer Warsh a significant strategic opening. If the Supreme Court rules to protect Lisa Cook from being fired, and the Department of Justice is forced to drop its investigation into Powell, it will solidify the legal boundaries of Fed independence. These rulings would establish a firm precedent for the central bank's autonomy, providing Warsh with the institutional cover he needs to prioritize economic data over political demands once he finally takes the chair. If he decides instead to bend to those demands, he risks repeating one of the most disastrous chapters in American financial history. In the early 1970s, Fed Chair Arthur Burns caved to intense pressure from President Richard Nixon, supplying the economy with artificially cheap money to ensure favorable conditions ahead of an election. The fallout was catastrophic. That surrender directly fueled a decade of stagflation. a combination of stagnant growth and rampant inflation that devastated the purchasing power of the American working class. Kevin Warsh is about to face the exact same test. If he caves to the president to deliver short-term political wins, he risks wrecking the economy and cementing his legacy alongside Burns. If he holds firm, he protects the value of the US dollar, but risks the wrath of the man who gave him the job.